All right, taking a look at housing starts, they rose for the second straight month in May, with construction on new homes reaching the highest level since last April, boosted by strong demand, which our next guest says could be a very favourable environment for homebuilder stocks. Rafe Jadrosich, Bank of America Senior Homebuilders Analyst, joins us now with more. Good to see you, Rafe. So as we look at some of this data that's been coming out over this past week, then, which of these homebuilders are in the best position right now?
Sure, great. Thanks for having me. So we do think it is a favorable backdrop for home builders right now. New home sales have definitely inflected positively year to date. We've seen a strong recovery after the slowdown at the end of last year. So if we think about specific home builders that we like right now, Toll Brothers is our top pick. We think it's really attractive on a valuation basis. It's trading just slightly above its book value with a return on equity that is far above its historical average. We also think it's well positioned to benefit from the tightness in the existing home market that you've seen out there.
Rafe, you all recently had a housing symposium earlier this month with home builders in attendance. What were the top three themes that you would say came up?
Yeah, I think the really big theme this year that's come out is just the tightness in the existing home market right now. There's just not a lot of resale inventory that's on the market. Historically, if you look at new home inventory as a percent of the total inventory that's available, it's about 10 or 15%. Right now, we've actually seen that increase to 30% of the total available inventory. And it's just existing home inventory is very tight. There's a rate lock-in effect that's going on right now, where about 80% of current homeowners that have a mortgage that's below 4%. So while mortgage rates are 7%, the incentive to move is very low. I think that the second kind of key takeaway that we had was that home builders are accelerating starts. You saw the data that came out earlier this week. Just in response to the really strong demand, we're starting to see a pickup in overall construction activity. And then the final, I think, takeaway would just be the supply chains are starting to ease. Still elongated build cycles, but we are seeing a little bit of relief there.
Yeah, Rafe, what are we seeing in terms of input costs? Because yes, we have seen some relief when you look at the price of lumber, for example, down substantially on a year-over-year basis. But in terms of how big of a challenge this is for home builders compared to what it looked like pre-pandemic, how does that stack up?
So if you look at the overall cost to build a home from 2018 to now, we think it's up about 45% if you just look at the materials. And home prices are up 47% over the same period. So we've still seen a lot of inflation. There is relief coming in right now from lumber costs, as you said. Lumber costs are down over 50% year over year. And that's the largest single input from a material perspective. When you look outside of lumber, the rest of building products generally are still inflationary. Labor is still tight, and land prices still haven't come down. So generally still an inflationary environment if you back out lumber, but lumber is a big tailwind to margins right now.
And Rafe, as we look year to date at some of these home builder stocks, some of them have been absolute rock stars. When you look at D.R. Horton and Lennar, they're both up over 30% year to date. Toll Brothers up over 50%. KB Homes up more than 60%. How much more upside do you still see then coming into the second half of the year?
Yeah, it's a great question, and the stock performance has been really strong, especially relative to the rest of the market. I think what's important about home builders is that the valuation is still below the long-term historical average. So usually they've traded at an average of about 1.5 times book. So the book value per share is actually increased by more than the stock prices over the last few years. So we're still probably about 10 or 15% below the historical long-term average valuation. So we still see some upside on the valuation side.
And Rafe, I got to ask you about with rates expected to climb through the rest of this year, what risk do you project that posing to the home builders, for instance?
Right. So obviously the 7% mortgage rate is definitely a big headwind to affordability. If you look, about a year ago, beginning of last year, mortgage rates were at 3%. They've gone all the way to 7%, a huge headwind to affordability. What we've seen is mortgage spread, so that's the spread of the 30-year mortgage over the 10-year treasury, are at all-time high levels. So even with the FOMC announcement last week and the commentary that you're still seeing 2 rate hikes, mortgage rates have actually gone down slightly over the last 3 weeks. So we think that spread is more than capturing the additional hikes that are coming, and mortgage rates we'd actually expect to be flatter down through the remainder of this year.
Rafe, what about pricing? Because we entered the year expecting, many were calling for a double-digit decline in home prices. We haven't seen that yet because demand has remained strong, inventory a huge issue, and people are willing to pay what people are asking for homes. Is that going to continue to be the case, do you think?
So if you look at new home prices, they're probably about 10% off of the peak levels. And that's a combination of incentives and price cuts from the home builders. And then we've seen a stabilization there. So there has been elasticity in the market. From the existing home side, it's been relatively stable. We're only 1 or 2% off of the peak level. And the story there is just the lack of available inventory. But home builders have seen a stabilization in prices. And there's actually some markets where they've come back and started to increase price again. So we would expect a kind of pricing to be stable between now and the end of the year.
And obviously, once you have the demand, you do want that supply. You know that inventory is an issue, but you also have a tighter credit environment. So what is that doing for construction loans to be able to get some of these buildings off the ground?
Yeah, that's a great question. So there's two aspects of credit. You have the consumer borrowing side on the mortgage rates, which we talked about how elevated they are, and then you have home builders that are borrowing to finance their business. From a private builder perspective, which we think is about a third of the market that rely on construction loans, the NAHB survey on the current cost to finance a single-family construction is 12.8% as of the first quarter. That's up, over 500 basis points over the last 3 years. So the cost to finance for a private builder has gone up really materially. So we think that actually positions public builders to take market share as private builders come under some cost pressure.
We'll certainly keep track of that. Thank you for joining us with your insights. Rafe Jadrosich, there, Bank of America Senior Homebuilders Analyst. Thank you for your time this morning.
Great. Thank you for having me.